In 2006, a bank could take a loan given to someone who couldn't prove they had a job and turn it into one of the safest investments in the world. Not through fraud, not through a loophole hidden in fine print, through a process so widely accepted, so deeply trusted that pension funds, insurance companies, and entire foreign governments built their savings on top of it. They called it securitization. Investors called it safety. Rating agencies stamped it AAA, the same grade given to U.S. Treasury bonds. The safest thing money could buy. History would call it something else. Welcome to Capital Historian, where power, wealth, and history converge. Because 3 years later, that same machine, the one that had been quietly converting risk into gold for over a decade, would help erase tens of trillions of dollars in global wealth in a matter of months. This isn't the story of a market crash. It's the story of how modern finance learned to lie to itself, dressed that lie up in mathematics, and got the entire world to buy shares in it. Every financial crisis starts the same way, not with a villain, with an incentive. In the early 2000s, the world had a problem money couldn't solve. There was too much of it, and nowhere good to put it. Interest rates were low. Government bonds, the safest investment on earth, were paying almost nothing, and global capital, sitting in the accounts of banks, pension funds, and sovereign wealth funds from Tokyo to Frankfurt, needed somewhere to go that paid more. They found it in an unlikely place, the American mortgage. For decades, a home loan was one of the most boring investments imaginable. Slow, steady, reliable. A family paying down a debt over 30 years. Not exciting, but not risky either. That was about to change, because someone figured out how to make the mortgage exciting. Here is how the machine actually worked. A bank issues a mortgage. Instead of holding on to that debt for 30 years, collecting slow, modest interest, the bank sells it, almost immediately. It sells that mortgage to a larger institution, which buys thousands of others just like it, bundles them into a single package, and slices that package into shares. These shares are sold to investors around the world as a new kind of asset, the mortgage-backed security. On paper, it looked ingenious. Spread the risk of one mortgage across thousands of investors, and no single default could hurt anyone too badly. Diversification, they called it, the same principle behind not putting all your eggs in one basket. Just apply to debt, but there was a problem hiding underneath the elegance. To keep manufacturing these securities, the banks needed a constant, growing supply of new mortgages, and they had already lent to everyone who could safely afford a loan. So the standards changed. Lenders began approving loans for people with no proof of income, no verified job, no down payment. These loans had a name, subprime, and they came wrapped in features that sound almost designed to fail. Adjustable rates that started low and quietly ballooned to 3 years later, right as a homeowner could least afford it. Normally, an investor buying this kind of debt would run. This is obviously risky, but something intervened between a risky loan and the investor's decision. The credit rating agencies. These agencies looked at pools of loans built partly on subprime debt and stamped a remarkable number of them AAA, the same rating given to the U.S. government, the rating that tells a pension fund manager, this is safe enough for retirees' life savings. And once that stamp was applied, demand exploded. Wall Street didn't just meet that demand. It built new products to feed it, riskier bundles, sliced and repackaged again, called collateralized debt obligations. Bets on top of bets. Several layers removed from an actual house, an actual homeowner, an actual risk of default. Home prices kept climbing, and as long as prices climbed, the entire structure had a safety net built in. Even if a borrower defaulted, the bank could seize the house and sell it for more than the loan was worth. Nobody, it seemed, could lose. Here is what almost nobody outside of Wall Street understood at the time. The entire system was insured against the one outcome nobody thought was possible. They were called credit default swaps, financial contracts that function like insurance policies on these mortgage securities. If the securities failed, the swap would pay out, except they weren't regulated like insurance. No one required the sellers of these swaps to hold reserves for the day claims came due. One company, AIG, sold tens of billions of dollars of this protection, collecting premiums for years, with almost nothing set aside for the possibility that the bet would ever be called. And these swaps didn't stay confined to the people who actually own the mortgage securities. They became a separate market entirely, a way for traders with no connection to a single house or a single homeowner to bet enormous sums on whether the housing market would rise or fall. Wall Street had built a casino on top of the mortgage market, and most of the players at the table had never seen a mortgage in their lives. This is a part of the story that reveals what the crisis actually was: not a housing problem, a trust problem, engineered at industrial scale. Every layer of the system depended on the layer beneath it being sound. The investor trusted the rating agency. The rating agency trusted historical data that predated the era of reckless lending. The bank trusted that home prices would keep rising forever. And everyone, quietly, collectively, trusted that someone else was watching the risk so they didn't have to. Nobody was. When home prices finally stopped climbing in 2006 and 2007, the entire structure reversed. Borrowers who owed more than their homes were worth began walking away. Defaults rose. The securities built on those mortgages lost value. The insurance sold to protect against that exact outcome came due, and the sellers didn't have the money to pay it. By September 2008, a 158-year-old investment bank, Lehman Brothers, collapsed overnight. Panic didn't just hit housing. It froze the entire global financial system because nobody could tell anymore which institutions were actually solvent and which were holding worthless paper dressed up as gold. The government's response: trillions of dollars in emergency lending, a $700 billion bailout program, a sweeping set of new regulations called Dodd-Frank. Stopped the bleeding. Markets stabilized. The economy slowly recovered. But here is the uncomfortable truth underneath the recovery. The machine wasn't dismantled. It was renamed. The specific loophole that let subprime mortgages become AAA-rated securities was tightened. But the underlying architecture, trust manufactured through complexity, risk hidden through layers, leverage built on the assumption that someone else will absorb the loss, never left the financial system. It simply moved. Today it lives in private credit markets, largely outside the reach of the regulators who tightened the rules after 2008. It lives in leveraged loan markets, doing exactly what subprime mortgages did 15 years ago, repackaging risk and selling it as safety to investors chasing yield in a low-rate world. It lives in the phrase, too big to fail, which didn't disappear after 2008. It got a permanent seat in how the largest banks are now regulated, insured, and when necessary, rescued. The 2008 crisis didn't teach the financial system that risk was dangerous. It taught the financial system that risk, taken at a large enough scale, becomes someone else's problem to solve. There's a sentence buried in the government's own investigation into the crisis, easy to miss, that says more than any statistic in this video. The people responsible for watching the system weren't at their posts, not because they were incompetent, but because almost everyone at every level had convinced themselves the market could police itself. That is the real machine, not a single fraudulent act, not one villain in a boardroom, a system where thousands of individually reasonable decisions, chase yield, trust a rating, sell the risk to someone else, added up to something no single person intended and no single person felt responsible for. Systems like this don't fail by accident. They fail exactly the way they were built to fail, quietly profitable for people running them, right up until the moment the bill comes due. And when it does, history shows us clearly who tend to pay it and who tends to walk away. The 2008 crisis wasn't the last time bad debt got turned into gold. It was simply the first time we got to watch it happen in real time.